What is the securitization process? Imagine turning a bunch of loans into a package that can be bought and sold like a stock. That's essentially what the securitization process does in financial markets. It's a way to make illiquid assets, like mortgages or credit card debts, easier to trade and more accessible to investors. This process helps lenders free up cash so they can lend more money, and it offers investors new opportunities to diversify their portfolios. The process kicks off when a bank or financial institution gathers similar income-generating assets, like home loans or auto loans. They pull these assets together into a single group, often called a reference portfolio. This pooling makes it easier to manage and sell the collection as one unit. Next, the bank transfers this pool of assets to a separate legal entity called a special purpose vehicle or trust. This step is important because it isolates the assets from the bank's other holdings, protecting them from any financial trouble the bank might face. Once the assets are in the special purpose vehicle, it finances their purchase by issuing securities. These securities are like bonds that investors can buy. They are divided into different layers, called tranches, each with its own level of risk and potential return. The top layer, called the senior tranche, has the highest credit quality and the lowest risk. The middle layer, called the mezzanine tranche, carries a moderate risk. The bottom layer, called the junior or equity tranche, has the highest risk but also the highest potential reward. This layered structure helps spread out the risk so that the safest investors get paid first and the riskiest take on the most potential loss. Investors buy these securities and receive payments from the cash flows generated by the loans in the pool. These payments include the borrower's principal and interest. The original lender often continues to service the loans, collecting payments from borrowers and passing them on to the special purpose vehicle or trustee, minus a fee for their service. Securitization benefits the financial system by freeing up capital for lenders, allowing them to issue more loans. It also gives investors access to a variety of assets with different risk levels and liquidity options. Over time, securitization has helped grow mortgage markets and other types of consumer credit. However, it also introduced new risks, which played a role in financial crises. That led to reforms to make the process more transparent and safer for everyone involved. In simple terms, securitization takes loans, pools them together, creates securities backed by those loans, and sells them to investors. This turns assets that are hard to sell into liquid investments, spreads out risk, and helps keep the flow of credit moving in the economy.